Let's listen in to Reema joining, who is talking to the management.
For 2 quarters now, on your margin front, you've operated below your stated margin guidance of 21 to 22% at the EBIT level. Would you look to tweak it lower or change your margin guidance?
First of all, we look at our margin profile based on a full fiscal, right? I would like to state that our guidance for the full fiscal 16 continues to be in the guided range of 21 to 22%. If you look at this is the first quarter for our fiscal 16, and I believe we started on a very strong footing. We grew by 30.5% on a constant currency basis Y-on-Y, which is very strong for us. If you look at our order book, that also is about 10% higher than what we have previously seen. And again, largely driven by the quality of the book that we have, right? One, driven by the recurring nature of IMS and ITO contracts, and the second, due to the complexity of the engineering work that we do. So that again is a very strong factor which we have in our, as we see this quarter, and then our comfort for the full fiscal 16 is really based on those parameters.
Okay, so FY16 EBIT margins maintained at 21 to 22%. So Mr. Chanana, if we adjust for the provision of $18 million that you've taken a hit this quarter, your margins are what, 19.4, 19.5% at the EBIT level. Do you believe they've bottomed out, and what will be the drivers which will push your margins up?
I think we started our investment program somewhere in early 2015, calendar 2015. We have significantly made those investments, and now we are reaping the benefit of those investments. As Anant explained, that we did our bookings have been our order book has been higher by 10% than it has been at the largest level, highest level, and that's testimony to the fact that those investments which we did in terms of bringing the digital and IoT, as well as creating the global delivery centers, is paying off. So now with the going forward, we will be able to, we have the levers which will help us improve our margins and at the same time invest in our business.
So what are the levers? And again, so margins at 19.45 have bottomed out?
Yeah, certainly. So the margin will be in the guided range of 21 to 22% for the full year.
Okay. So we'll come back to the margin issue. So let me come on the revenue front. This quarter, you'd already cautioned that 3 factors will affect your revenue: client-specific issues, revenue skewness in infrastructure management, and thirdly, cross-currency. Currency is not in your hands. But on the first 2 factors, will it affect you all in the coming few quarters as well? Any spillover?
So I think the first important thing to look at is look at the Y-on-Y performance even in this quarter for the different lines of business, right? Engineering grew by a little over 23% Y-on-Y. That kind of indicates the quality of the growth on a consistent basis. BPO also did very well, and infrastructure delivered around 16.7% Y-on-Y on a constant currency basis. Application not bad at 7.7, around the industry average. So when you look at any quarter, the way we look at it is comparing it both on a Y-on-Y basis, how is it really growing for us, right? So I would say that there is a very healthy growth rate that these different lines of business have delivered from this quarter perspective, especially given that it's our first quarter for the fiscal. Now, with respect to the infrastructure business, again, we, as we speak, are transitioning and transforming, more than 10 engagements in different stages, right? They will kick into revenue, in my view, sometime in the second half of the fiscal for us. But if I look at it from a full fiscal perspective, for the last 3 fiscals, we have delivered an outperforming performance when you compare over the top 3 players in the industry, and we are extremely confident of delivering that even in this fiscal.
So our performance in infrastructure management will continue. But Mr. Chanana, a couple of your peers have cautioned us about the second half of the fiscal year, that's the coming 2 quarters. Apart from seasonality, do you see any factors which will affect HCL Technologies' performance?
I don't believe there is any factor which is impacting us negatively. Seasonality is only I would say, limited to India business, which comes down in the second half of the year. Other than that, there is no other seasonality factor. And our reliance on India is very, very small. It's now less than 2% of our revenues.
So was India business the reason why your rest of the world performance was bleak in this quarter?
That's correct.
No other factor apart from India which will affect your...
Apart from the currencies, India was one of the factors.
Okay. Mr. Gupta, you spoke about engineering and how it's now turning out to be such a big growth driver. You've announced a small acquisition, a Bangalore-based private company. How big is this acquisition? Could you reveal the financial size?
So if you go back as to, what is this organization, it is really in the semiconductor space. Extremely high in engineering capability in semiconductor. HCL has a very strong portfolio in semiconductor engineering, and it is really a competency-based acquisition. Sub $10 million, not large from a revenue standpoint, but really from a capability and the way we see the semiconductor industry moving, we believe it will be a great fit based on which we can scale up. And by the way, our engineering business this quarter has become the #3 player globally. So, from that perspective, we do believe in making forward-looking, competency-based acquisitions which we can then scale up across the globe.
Okay. So if things are looking good, your order booking is 10% higher, I believe at a record level as well. What's the outlook, say, for FY16? In FY15, on a constant currency basis, you ended the year with 15.1%. Without getting into numbers, will it be better, as good as, or a little lower than what you clocked in the prior year? And how would it compare with the industry?
So like I said, for the last 3 fiscals, we have outperformed the average of the top 3. And for fiscal 16 also, we will outperform the average of the top 3. That's the only guidance I can give you. And I think it also reflects, one is the order book. If I look at the bookings in this quarter, we booked, in excess of $1 billion.
But you've been doing that for the last many quarters now.
True, and I think it's an important thing, and it was an element we discussed earlier as well. From our perspective, while the complexity of the deals has increased and therefore the conversion into revenue has become a little longer, I think it's only a positive sign for us because it is getting us into more complex transformational engagements. Therefore, from an addressable market perspective, it is really helping us. So yes, a couple of quarters here, a couple of quarters there is not really the thing, but does it really get us thick into some of the engagements which are still in key markets, especially when you look at, let's say, the DACH region, which is Germany, Austria, Switzerland, or if you look at Benelux, which is France and Belgium, they're still largely untapped from our perspective. And therefore, we believe that engagements in those markets will be complex. They have been complex. They will be complex for a period of time. But nevertheless, there's still a significant enhancement of the addressable market that we are playing in.
Mr. Chanana, could you help me and break up the margin for us if you include the provision hit of $18 million? And what will be the impact of wage hike going forward?
So the wage hike this quarter had an impact of 85 basis points. But in spite of that, our margin, if you look at EBIT level, went up from 20.1% to 20.5%.
But that's if you're stripping out the provision here.
That's correct. So even if you bring in the provision, it has only increased. I mean, I'm just keeping it out for a second, just to make a apple-to-apple comparison, I would say. And going forward, it will be 75 basis points next quarter, which will have an impact because of the salary increase. But other than that, as I said, there is a good amount of tailwind which is there, where we will be able to, through automation and other measures, be able to improve our margins. If you look at our per engineer realization is the highest at 58,400. So we believe we will continue to sort of go on that journey.
Your peer has come out with a productivity target, a 5-year plan of reaching productivity to $80,000 per employee. You're at 58,400, I think you just said. What would your target be? How much do you think it can rise to?
We haven't pegged a number, but the fact is we believe in delivering. Right, for the last 3 years, if you look at the realization per employee, it's been the highest in the industry. Actually, a good 20 to 25% higher than the industry. Our automation story is not something we've started today. We started that 5 years back with our first framework called MTAS. 3 years back, we launched what we call as AuTOps, which is for operations. And as we go forward, we will add a lot more as well. So I think that journey is a consistent journey. We will continue to build on that. And especially when you look at the digital environment and look at our investments we've been making in next-gen ITO, that is really what that is targeted at.
Okay. Mr. Chanana, on attrition, it's been above the 16% mark for the last 6, 7, 8 quarters, if I'm not mistaken. Is it going to be the new normal, attrition at these levels, or do you see it coming down?
I think this is the performance cycle, so it has more to do with the performance cycle.
But even in the other quarters, it's still been above.
It comes down over in the other quarters slightly by a couple of, I would say, points.
But it should stay around this?
I would just to add over there, I would say it's a couple of points higher than what we would like it to be.
Okay.
You know, so ideal operating rate should be in the 14.5%, so we would be comfortable in that area. But given that we acquired, we had significant rebadging last year as well, 3,000 on site compared to 700 before, and the changing nature of the market in terms of the capability, right? So we believe that the right range ideally is around 14.5%.
Okay, that's the management of HCL Tech saying that they have, or the margins have bottomed out at 19.5% and they expect that 21% sort of range to possibly be where the margins will settle at. That's HCL Tech, stock down around 0.6%, but off the day's low.